Good morning. Good morning. Oh, okay, thank you. Let me not waste your time this morning, but to proceed from where we left in the previous session. I remember when we looked at um, in our first session, actually, we covered a number of topics or a number of concepts where I remember we introduced financial management as a function. Then we also looked at basic concepts in financial management, your capital, income, uh, costs. We looked at those aspects. And in this session, we are going to proceed from the objective of financial management, be it financial management as a discipline or financial management as a function in an organization. Those that study financial management, why do they study it? And those that actually work in the financial management function of an organization, what is it that they seek to achieve in the organization? So it is important for us to realize that the long-term objective should be to increase value of the business. So this is the long-term objective that those that are working in the financial management function of an organization should always have. And if you have studied also your chapter 6 well, Introduction to General Management, you will also have realized that the long-term vision of an organization, or the main objective of an organization, is also to increase the value of the business, or to increase or maximize the value for the shareholders, which is basically for the business. Because shareholders are those that own the business itself. So to increase the value of a business, there are two ways that financial managers can actually attain that. One being investing in assets that will add value to the business. And with assets in this case, we mean both long-term assets or your fixed assets, those that cannot easily be disposed, maybe buying land, equipment, machines, and so forth. That will benefit the organization in the long run. Another way may be to actually invest also in current assets, but reasonably, not to just do it carelessly, because there are also disadvantages of holding too much current assets. So they may also invest in acquiring stock, keeping some money as cash, or as bank, which may be easily available for the organization. They may find means to invest in current assets, sell on credit so that you increase also your debtors. But this should be done in a way that will benefit the organization, which means they ought to apply their minds correctly. Then the other way of increasing the value of the business is by keeping the cost of capital as low as possible. Cost of capital, in short, or in simple terms, may relate to interest. The interest that you are charged when you acquire financial resources. So in case where you want to borrow or to raise funds, financial managers should always ensure that the cost of capital is kept as low as possible. So if there are two parties that are offering us financial resources, one may be offering an interest rate of 10%, another one offering an interest rate of 8%, we should be able to take that which will ensure that we keep the cost of capital as low as possible. That is, we should borrow from those that are charging lower interest rates and also offering favorable conditions. So the long-term objective of financial management is to increase the value of the business, and it can be done by investing in assets or by reducing the cost of capital. Then coming to the short-term financial objective, if I had asked you what is the main goal of the business, I'm sure I was going to hear from you saying it is to maximize profits, to ensure liquidity and solvency of the business. But these are short-term objectives, or these are short-term goals of an organization. The long-term objective is to maximize shareholders' interests or to maximize the value of the business. But that cannot be achieved without the business making profits, without the business itself being liquid. There are other organizations that closed down, although they were making profits. They failed. So it is possible to actually fail as an organization, although you are making profits. And I repeat, it is possible for organizations to fail, although they are making profits. Or to make it more easier to understand my point, I am saying it is possible for an organization to fail for financial reasons, to actually close down because they do not have money to operate the organization, simply, although they are making profits. So the issue of liquidity is very important. You can fail whilst you are making profits, but for as long as you do not have working capital for the day-to-day operations of the business, you can actually fail and close down. And there are lots of businesses that have failed as a result of liquidity problems. Solvency, excuse me, is also another challenge. If you are to close down today, can you pay back those that you are owing from the sale of your fixed assets or from the sale of your assets? So it's also another aspect that should be monitored because creditors, they always look into that. They are more interested in your solvency. Are they able to recoup whatever they invested in the organization in the case that the organization closes down? On this particular slide, I'm not sure if we are still together or if there's someone with a question. If you have a question, please feel free to ask so that we move on together. Any question? There are two things that one can read when people are not asking any question. It can be, it's clear, but on the other side, it may also be that they did not get anything. So maybe just to ensure that we are moving together, I will be glad if you can type one thing that you got from what I said from this slide. Or if you can say something that you got from what I have explained from this slide. Can we do it quickly, guys, so that we can move on? Okay, I mean those that are in the session. I know it may be possible also that some just logged in and disappeared. Okay, thank you, Siabulela, thank you. Then we move on to the fundamental principles of financial management. Uh, they look so simple to understand, easy to understand, but we have realized also that some people struggle to understand these basic principles. Tabiso has put something in the chat box. He's saying, I thought that business shut down because of the risk, which is high, and the gearing, which is negative. But now I also know that it can be closed while it is making a profit. Uh, it can be closed, it can fail whilst it's making profits because of cash flow problems. So as a financial manager, you should not only focus on profitability, you should also look at issues to do with liquidity and also issues to do with solvency. So in the case of small businesses, the majority of them that fail for financial reasons actually fail because they fail to manage cash flows. I think to explain it also in layman terms is that the profit that you realize in your documents, in your income statement, include or may have been calculated from a sales figure where one may also have sold on credit. So that sales figure in your income statement, in most cases, it includes both cash sales and your credit sales. So it is possible that you realize a profit before those that actually bought from you have paid you. So your documents may show that you have a profit, but you may not yet have received that income. But I think it's something that we will also look into when we finally look into the actual documents themselves as we proceed. Coming back to the fundamental principles of financial management, there is what is known as the risk-return principle. Then we also have what is known as the cost-benefit principle and the time value of money. Okay, let me just explain the principles. The risk return principle with this one, before you decide on whether you will invest in a particular project, before you decide or before you make that financial decision on whether to invest or not to invest in a particular financial project, you ought to assess, or one ought to have assessed the risk and the returns. So in simple terms, you compare the level of risk that is involved and the returns that are expected. As a financial manager and using the mechanisms that may be available, you should be able to compare those two. And if the risk is far more greater than the returns expected, then there is no need to invest in that particular project because you may lose your capital. But if the returns are promising to be greater than the risk, then there is every reason to actually invest in that particular project because the returns outweighs the risk. you tend to benefit. This is the reason also why in your chapter 2, when you did your chapter 2 on entrepreneurship, you described entrepreneurs as risk takers or as calculated risk takers. What they do, they apply the risk return principle. Then they compare whether that particular risk is worth taking. But for you to know whether risk is worth taking is only when you compare it with the expected returns. What do you tend to benefit? So if the returns are greater, obviously you go for that decision. But if there are no returns, or if the returns are far less compared to the risk, there is no need to invest. Unless if you want to commit financial suicide and lose everything that you have. Then there is also what is known as the cost-benefit principle, which is more or less the same with the risk-return principle. But in the case of cost-benefit principle, the focus is not really on risk. It is on the costs, which we looked at in the previous session. Your direct costs, your overhead costs, all the costs that you can think of, fixed, variable, semi-variable, all the costs that you can think of. You compare those costs involved in that particular financial project against the benefits. So you look at the costs, you also look at the benefits. Then you compare the two. If the costs outweigh or are far greater than the benefits, then there is no need to invest in that particular project. But if the benefits are greater than the costs, then it is worth it. You can actually invest in that project and gain something. I think those two, they are more or less the same with common sense, although they say common sense is not always common. But I think in our real life, when we make decisions, we actually apply these principles. That before I do anything, what is it that I tend to benefit? What are the risks? What are the costs? Is it worth doing? But the same with financial managers. There are good financial managers. There are also bad financial managers, which is also the same thing that happens in life. We have people who are good in making decisions. They make good decisions. We also have people who just make bad decisions. But as prospective financial managers, it is prudent that you always apply your mind before you make a financial decision. You actually compare the risks and the returns. You also compare the costs and the benefits. I hope we are together on this one. Or on those two fundamental financial management principles. Then the other principle is what is commonly known as the time value of money. And on this one, before I explain what I think I ought to explain, it is important also for me to pause and ask a question. If you have been informed that you will receive 1,000 rand, let us keep it low to 1,000 rand. Assuming you have been told at the beginning of the year that in this year 2022 you will receive 1,000 rand that you will use for whatever reason, would you prefer to receive it at the beginning of the year or at the end of the year? If you had been told in January that you will receive 1,000 rand, which you will use for whatever reason that you may, would you prefer to use it at the beginning of the year, that is in January, when you are told, or you would actually prefer to receive it in December, although you had been informed in January? Can you also type your responses either January or December in the chat box? On this one, I expect everyone to type either January or at the beginning of the year, or either December, which is at the end of the year. I'm waiting for everyone. Everyone, please. I may also use this as my register to prove that you were actually in the session or you were not in the session. Okay, I think everyone who is in the session have put in their view on whether it can be they would prefer to receive it in January or in December. From my quick count or quick observation, it seems those that are saying in December, they are far more than those that are saying in January. Those that are saying at the end of the year, they are far more than those that are saying at the beginning of the year. So could those that are saying in December, please share your views. Why would you want to receive it in December? Please feel free, you can unmute and give your reasons. Why would you want to receive it in December, not in January? I'm sure everyone who has typed, they have a reason. So you can just let us know why December. Zukisen Sogoni, Spamandla, Kanyiswa Bilitani. There's also, yeah, there are quite many who said at the end of the year. Ukona, Asenati, Wonolo, please, can you share with us why would you want to receive it in December? Okay, Nokuzola is saying that will allow her 12 months to budget. Okay, and others, what are your reasons? Those that said in December, please, we don't have much time, we need to move on. Why December? Ntombizanele, I'm not sure if that is true, that things are cheaper at the end of the year than when you compare at the beginning of the year. Those that know in January and December, maybe, I'm not sure, but yeah, it may not, that point may not really hold water. But all the same, we accept it as your view. Okay, those that said in January. Okay, Atula is also saying at least in December, then they will know that they can use it for something, unlike to just keep it. You end up using it for something else. I'm not sure what Siabulela had said that Tabiso is agreeing to. Okay, Siabulela said they would rather prefer to receive it in January, because that way they will be able to do something productive with the money than to just keep that money as 1,000 rand. Okay, so laymen are those that do not have basic financial management knowledge. They do not see the time value of money, which I'm glad at this stage that some people actually prefer to receive money at the end of the year instead of receiving it earlier. Or some people may not prefer to receive money now. They may prefer that someone else keeps it and benefit from that money and only give them the little that they had at the beginning. But since you are financial management students, allow me also to explain that time value of money without offending anyone. Basically, the dollar that you receive today is far greater than the dollar that you may receive tomorrow. Or the rand that you receive today is far greater than the one that you may receive tomorrow. Before we move to explain more, I want to bring it to your attention that there is something that is called inflation that you guys covered in economics. So the money that you may have received in January, you would have been able to do more with it than what you may be able to do in December with the exact same amount. That is if you factor in inflation. So money tends to lose value with time. Money tends to lose value with time. So because money tends to lose value with time, it is better to receive your money today than to receive it later. But that also calls for financial discipline. So as an organization, you ought to be in a position to budget your finances and also to invest your finances. But if you are not able to budget and if you are not able to invest, that doesn't take away the effect of inflation. Inflation is just like gravity. Whether you believe it or you don't, it will still pull you down. It will still have an effect on you. It's not something that will only have an effect on you if you believe it or if you take note of it. Whether you take note of it or you don't take note of it, it will affect you. So if you consider inflation, I'm sure you will agree with me that 1,000 rand that you may have received in January will do far more than 1,000 rand that you will receive in December. That is the first point. Take note of the effect of inflation and the fact that money tends to lose value with time. Then another point is what a few guys who said they would rather receive their money in January have also raised. They stated that January, then they also provided reasons. If you receive your money in January and you do not want to use it, without making any complicated financial decision, you can invest it in a simple interest earning account. Maybe at the current rate of interest, you may, by the end of the year, you will have earned, if it's 8%, you will have earned 8%. And your money will no longer be 1,000. It will be 1,000 plus the interest that you earned. That is without making any complicated financial decision, just receiving your money and investing it in a simple or in any interest earning account. As long as you do not put it under the pillow, it will earn interest. So for those two reasons, that if you receive your money today or earlier, you can invest it, and you can invest it and earn interest, or you can actually use it before it's affected by inflation. So for those two reasons, it is always good to receive your money today than later. It is always good to receive your money earlier than later, so that you decide on your own on how you can invest it and benefit also from the investments. I don't want to highlight to you some of the instances where you had your money invested by someone benefiting from the interest, and at the end of the year, or because of delayed payments to you, they will only pay the capital amount and enjoy the interest. I'm sure you also have examples where your money may have been made available to you at the beginning of the year, but there are certain people or organizations that may have financial management knowledge who will then take advantage of those that lack financial management knowledge. That no, we can actually invest this money, earn interest. Maybe after 6 months, we make this money available to them. They do not understand the effect of inflation. They do not understand that money is not kept under the pillow. So if we keep it for them, we invest it and generate interest. When we pay it back to them, we only pay the capital amount and not the interest. In simple terms, the time value of money principle states that a rand received today is worth more than a rand that can be received tomorrow, because of the issue of inflation and also because of the interest that can be earned through investment. I'm not sure if this has been clear. I'm not sure if this is clear, or if there are people with questions. I will also accept a comment from those that had said they would prefer to receive their money in December, if there has been any change of mind with regards to that. Okay, thank you, Nokuzola. Okay, we move on to cost, volume, profit relationships. Cost, volume, and profit. How are those related? So profitability is determined by the unit selling price of a product, the cost of the product, and the level of activity of the business. Basically, we are saying profitability is determined by the sales. And when we discussed sales in the previous session, we said it's the quantity that has been sold multiplied by the price or the unit price of that particular product. So to calculate profitability, it's basically the sales, then you deduct the costs, as we discussed in the previous session. So a change in one of those three components, that is the unit selling price, the costs of the product, and the level of activity. If there has been any change in those three aspects, it will also have an effect in the total profit that can be earned. And these are interconnected, as I said. To calculate sales, obviously, you look at the number of units sold, then you multiply by the price per unit. Then there is also what is known as the break-even point, which I am happy because you covered in economics, microeconomics, that is equal 111. In your case, it should be equal 111F and equal 121F. That was microeconomics. They explain to you what is known as the break-even point, and at that point, that's where your total costs are basically equal to your total income, and there is no profit. In your chapter 2 for business management, entrepreneurship, I'm sure you will also have learned that entrepreneurs struggle as they establish their businesses to reach that break-even point, because in some cases at the beginning of the year or in the first year when they establish their business, they may operate at a loss. So they may be fighting to at least reach the break-even point, where in as much as they are not making any profits, but they are also not making any losses. So any step in the right direction will then lead to them earning profits. So for financial management students, it's also important to understand the break-even point. That knowledge that you gained in economics, we still need it in financial management. There is a simple formula that can be used to calculate the break-even point, but I will not stress you with it in this current session, because it's something that I know you may already have mastered in economics. I will also provide an example where we will actually calculate the break-even point. The break-even point. Normally, it's if you are to calculate the number of units that will lead you to the break-even point, you divide your fixed costs with the marginal income or with your variable profit, which is basically how you guys calculated it in economics. Yes, I'm hearing Tabiso is also saying, and also in accounting. So basically, the calculation is still the same. It doesn't change. But what is most important at this stage is to understand that at that point, you are not making any profits and you are also not making any losses. This same break-even point can also be calculated in terms of income and also in terms of the quantity. Okay, coming back to the time value of money, yet I know I should not have explained the principle, but I'm glad you already understand the principle which I explained earlier. We now need to look at the time value of money, because for purposes of this module, you are also expected to have a basic understanding of how future values can be calculated. Like to say, if you have this amount today, how much may it be if you invest it in an interest earning account earning a particular interest rate? How much may it be in the next 5 years or in the next 10 years? With compounded interest or without compounded interest, a business management student should be able to calculate that and make an informed decision. We can also, you should also be in a position to say, if you want to save an amount of, let's say 50,000 Rand in 10 years, how much should you be investing in an interest earning account, be it on a yearly basis or on a monthly basis, to be able to have earned that target amount of money? So we can also calculate present values when we only have future values and the interest rate. So the time value of money considered the combined effect of interest and time. So you should not ignore the issue of interest and time. Time is important because money tends to lose value with time as a result of inflation. And the time value of money can be approached from two perspectives. That is, you can calculate the future value of some given present value, or you can also calculate the present value of some expected future amount. I'm sure I explained this. Basically, this figure, which is also in your textbook, shows the relationship between present values and future values. And in this case, you should remember the compounding effect of interest, and also when you want to reduce it to present values, you should also discount so that you remove the effect also of interest. So we can calculate the future value of a single amount. Then we can also calculate the present value of a single amount. Okay, let me come back so that we explain this and move together. With the future value of a single amount, there we ought to take note of the compounding effect of interest. Because once interest has been earned, it now forms sort of part of the capital. So it also earns interest in the next month or in the next year. You start to also benefit from that interest that you have earned. So amount of interest earned in each successive period is added to the amount of the investment at the end of the preceding period. So if you had, let's say, 1,000, then you have earned an interest rate of 100 Rand, maybe in the first month, in the first year. In the second year, when you are calculating interest, it's no longer interest on capital, which is your 1,000. It will now be interest on 1,100. So that's the effect of compounding. Interest is therefore earned on capital and interest in each successive period. And the formula to calculate the future value of a single amount is given, where you need future value, you need to multiply the present value with 1 plus the interest rate, and you also take note of time, which is the number of years. So that formula is very important. We will also revisit it when we work out some examples. Then to calculate the present value of a single amount, also take note of the formula, which is also in your textbook. Take also time to go through it in your textbook. But here, what is important is to note that we are no longer taking note of the effect of compounding, but it's the issue of discounting, so that we remove that interest that may have been earned and go back to the present values that should be invested in order to earn what are the future values that we have. Okay, then we also have we also ought to take note of financial analysis, financial planning, and financial controlling. And financial analysis is necessary to monitor the general financial position of a business and to limit the risk of financial failure of the business as far as possible. We have a number of tools at our disposal to conduct financial analysis. And part of these tools include the statement of financial performance, which is your income statement. Then we also have the statement of financial position, which is commonly known as the balance sheet. We can also make use of financial ratios, which I like more because they actually give an indication of financial performance in terms of profitability, liquidity, solvency. They make it so clear whether the business is at risk or whether the business is actually performing well. Instead of merely looking at the financial statements, the use of financial ratios make it easier to see whether a business is performing well or whether a business is actually struggling. Okay, so this is an example of a statement of financial performance, starting with sales, less cost of sales, then you have your gross profit, until you have the undistributed profit for the year. It is also important that in your own free time, you go through these financial statements so that you understand how to draw up a statement of financial performance or an income statement. In as much as we will not teach that in BEC with the assumption that you covered it in accounting, it's always important that if you did not master it in accounting, please see also examples on how to draw these financial statements, because that will be necessary. Then we also have, for the statement of financial performance, you should know that that's where we find the sales figure, that's where we find the gross profit. We also find the net profit after tax, net profit before tax, operating profit, and retained profits. That's where we also find the figure for stock, the closing stock. We can find it in the statement of financial performance. The figure for stock, we can also find it in the statement of financial position, which is the balance sheet. And I will explain, I'm sure, when we are looking at financial ratios, why it is so. Profit, we also find it in the income statement, but we also transfer it to the balance sheet. So you end up seeing it also in the statement of financial position. And that is basic accounting. As the statement of financial position provides a snapshot of the financial position at a given period, at a given time, not period. So it's prepared as at, not for the period. And that's the one where you have your asset side, then you also have your equity and liability side, for which your assets and how those assets were financed, the amount should always be the same. They should balance. That's why they end up calling it the balance sheet. Then we also have financial ratios. So a financial ratio gives the relationship between two items or even two groups of items in the financial statements. So you can take items from either the income statement, your balance sheet, then you draw up your financial ratios or you calculate your financial ratios. These serve as performance criterion to point out potential strengths and weaknesses of the business, which you may not pick if you generally look at the financial statements without calculating the ratios. So the ratios come, they actually assist in you as a financial manager or in you as a prospective financial manager to tell on whether the business is at risk or on whether the business is actually performing well, but using information that is readily available in the financial statements. We have what are known as liquidity ratios, and these, they indicate the ability of a business to meet its short-term obligations as they become due without curtailing or ceasing normal activities of the organization. In layman terms, we are saying they indicate on whether an organization will be able to pay its short-term debts as they become due. Those current liabilities, when they just pop up at our organization and they demand their money, are we able to pay them from our financial assets, from our current assets, those assets that we can quickly liquidate, like cash equivalents, cash in bank, or the amount in bank, debtors, and in some cases stock. I say with caution, in some cases, for a particular reason. So for the liquidity ratios, we have what is known as the current ratio. I see on my slides they are looking funny, so it's also important to go back to your textbook. The current ratio is basically calculated as current assets divided by current liabilities. So you add all your current assets and you divide them by your current liabilities. Then we also have what is known as the acid test ratio. Acid test ratio, to calculate it, we add all current assets, then we deduct inventory, which is stock, and we divide by your current liabilities. Anyone who has an idea why the acid test ratio is important in determining liquidity? Is the current ratio alone not sufficient? Okay, the reasoning there is that it's not always easy to convert stock or inventory into cash. So if you look at financial statements, in most cases, there is, especially in your income statement, there is always opening stock and closing stock, which means stock is not always sold completely. If you look also in your balance sheet, you always have a figure for stock or inventory there, which tells also that inventory itself is problematic as a current asset. It's not something that you can easily convert into cash when you want to. So we should remove it. So on that note, it is also important for business management students at first year level, and you guys are already in your second years, to go a step further and read also on the recommended ratio for the current ratio and on the recommended ratio for the acid test ratio. Normally for current ratio, it ought to be 2:1. Then acid test ratio ought to be 1:1. But I urge you to also take time, read why it is so and why it is necessary that it is like that. Yes, that is Atule. You should not only rely on the current ratio, because current ratio includes stock in the assets, which we cannot easily convert into cash. So you should go a step further and also calculate the acid test ratio, whereby you calculate that liquidity, but without depending or relying on stock to pay your short-term creditors or to pay your current liabilities using stock. So you should remove it from your current assets to calculate the acid test ratio. Then we also have solvency ratios. These indicate the ability of a business to repay its debts from the sale of assets when the business finally closes down or when it stops operating. When they decide to close down, are they able to pay whoever that they are owing from just the sale of assets? So we have the debt ratio. I see also on my slides it's looking funny. I'm not sure how they moved, or I'm not sure who moved them. But debt ratio, basically, it's total debt over total assets, and it should always be expressed as a percentage. So you should then multiply it by 100 over 1 to convert it to a percentage. So the debt ratio is always converted to a percentage, and it's calculated as total debt over total assets. For business management students, which is everyone in the session, you should also be able to recommend a debt ratio to say which level of debt ratio is acceptable. whereby if it's above 50%, can you say it's still safe? If it's below 50%, can you say it's recommended? But this is something that I want you to go and study. It's there freely given in your textbook. It doesn't even need any explanation. In one line, it's given. So you need to go and also read on your own as a student. Then we also have what is known as the gearing ratio, whereby we try to see to what extent is the business financed by debt. And to calculate gearing, we divide owner's equity by total debt. Again, there is what is recommended, which is given in your textbook. I'm saying there is what is recommended and is given in your textbook, not that we just passed this particular slide, but because we are going to test you on that. So it is important that you also find time to visit your textbook, interact with your textbook, particularly on these aspects, so that you will be able to address questions and answer them correctly as a financial management student. Okay, then there are also profitability, rate of return or yield ratios, which are basically profitability ratios. These are clearly given. They also highlight issues to do with profitability in the organization, like your gross profit margin, net profit margin, return on total capital, return on owner's equity. These ratios are also clearly explained, the formulas are given. So it will be necessary for you to also revisit your textbook or visit your textbook, because I know some have never seen it. Some have never seen the textbook. So at this time, you ought to visit it and see some of the examples so that you can see how these ratios are actually calculated before you are tested to calculate it. Okay. Gearing ratio, let me see. Yes. Tabi, so gearing ratio is not reduced to a percentage. It remains a ratio. So once you calculate it, you reduce it to a ratio. You do not leave it as a fraction. It's only the debt ratio that is converted to a percentage. So I'm not sure what you are saying has changed, because it's still expressed as a ratio. The gearing ratio is always expressed as a ratio. But the debt ratio is the one that we convert to a percentage. I'm not sure if we are together now, or if you had confused the gearing with the debt ratio, or if you had thought that the gearing ratio should also be expressed as a percentage. But the gearing ratio, you must always leave it as a ratio. You calculate it as a fraction, but you reduce it to a ratio, not to a percentage. Oh, okay. Yeah, it changes with the textbook also that is prescribed, but the principle remains the same. We are supposed to proceed to financial planning and controlling, but we have 20 minutes. I'm not sure if we should proceed or if we should leave it here. Then we proceed from here in the next session, which is tomorrow. Any indication from the class, but I'm glad to leave it here for today. Then we start on financial planning and control tomorrow. Okay, thank you so much for attending. Please go back to your textbook. Let me not say go back because others have never been there. Please visit your textbook. It's available in the library. It's available online. I gave you the link. Enjoy reading your textbook. It's yours. Even though you did not buy it. I know some did not buy it. The university has made it accessible online for free. Enjoy reading your textbook. So that next time when we start, we are starting on this particular slide where we will look at financial planning and control, so that we move towards the end of this chapter. That's where we are looking at issues to do with budgeting. These ones are not that complicated. We should be able to move faster because this is the longest chapter actually in this semester. Siabulela is saying there are discussions on Blackboard. How do you participate? Normally there are questions there and you are supposed to participate in answering those questions. So last semester we had tutorials, we also had discussions on Blackboard. This semester we also have tutors who are assisting, and we also have discussions on Blackboard. So discussions on Blackboard, your tutors, they also monitor who is participating, and you should be participating really. You should be participating really, so that you do not lose any of your marks. Because for the tutorial marks, I know there are tutorial tasks. I think you have 3 as per your learning guide. There are 5 marks that are only reserved for tutorial participation and for participation in those Blackboard discussions. So I see no reason why someone should lose those marks of just attending and participating in a tutorial session and also participating on Blackboard, something that you can do at your own free time. If you sacrifice your social networks for a moment and you participate in group discussions or in those discussions on Blackboard, I think it will be of benefit. So when you log on to the course, look for discussions. If you open there are discussion panels or discussion forums. You can actually start your own topic and have others contributing as far as it's content related. We don't want topics that are funny. Last time I ended up deleting after someone started something on Mjolo, and I was like, what is this now in the course? We don't have that topic. So for this semester, it should be on financial management, purchasing and supply management, and your and your strategic management process. Yes, they are posted regularly. Currently, the only post that I remember of or that I know of is the one where you are supposed to introduce yourselves, share your expectations for the module. That's the one that I'm aware of. But soon there will be discussion forums for financial management. If it's not yet there, I will have to open it there today so that if anyone has something to discuss, anything to have others participate in a discussion, they can open a forum and the discussion goes. It's controlled. Your tutors monitor. I also monitor. Tabiso gearing is on the same slide that is open now. And also we can take it to the discussion forum. Since we had said the session, we are leaving it here. We can take that one for gearing and debt ratio to the discussion forum. Let me quickly open the forum for financial management so that you can now start to participate and have your tutors also guiding you in the discussion forums. So thank you so much for attending. I will see you tomorrow. I know we have a session starting at 11. So it will be good that we all attend and we move also to compensate for lost time last week when I was not around. Guys, which ratio are you saying I didn't show? Atule. Are you guys seeing the slides? Because the slide that is projected now is the one with the ratios. Oh, okay.